Imagine waking up tomorrow and discovering that your net worth has finally crossed $100,000. For years, that number felt impossible. You saved, you invested, you said no to things your friends bought, you watched your account slowly climb from $10,000 to $25,000 to $50,000. Then one day you see it $100,000, and something strange happens. You stop thinking like the person who built the first $100,000. You start thinking like someone who has already made it, and that psychological shift can become one of the most expensive money mistakes of your life. Because the first $100,000 isn't the finish line. It's the moment when your financial decisions start becoming dramatically more powerful. But it's also the moment when lifestyle inflation, overconfidence, and bad investments can quietly destroy years of progress. So, what changes after $100,000? And why do people who successfully build their first six figures sometimes struggle to build the next? The answer has surprisingly little to do with math. It has much more to do with what happens inside your head. For most people, the first $100,000 is painful. You have to build the habit before you have the money. If you're earning $50,000 a year and have $5,000 invested, your portfolio doesn't feel very exciting. A 10% return gives you $500. That's useful, but it doesn't change your life. So you learn to rely on your behavior. You save consistently. You avoid unnecessary debt. You invest when you can. You keep going even when the numbers look small. But eventually, something changes. Suppose you've reached $100,000. Now a 10% return isn't $500. It's $10,000, and suddenly, your money has a larger voice in your financial life. That's the hidden turning point. Your savings still matter, but your existing capital starts mattering too. Think of it like pushing a heavy boulder up a hill. At first, almost all the movement comes from you. You push, you sweat, you move a few inches, but eventually, you reach the top of the hill. Now gravity starts helping. Your money can begin producing more money. That's the power of capital. And here's where the mistake begins. People reach $100,000 and think, I finally have enough money to spend. But the better question is, how can I make this $100,000 become useful enough that I don't have to work so hard for every future dollar? That's a completely different mindset, because $100,000 is not wealth in the way most people imagine wealth. It's leverage. It's a financial machine that you finally built large enough to matter. And if you keep feeding that machine, something incredible can happen. But if you start draining it every time your income rises, you may spend years rebuilding the same foundation. Here's a simple example. Imagine two people, Alex and Jordan. Both reach $100,000. Alex thinks, I've been responsible for years. I deserve an upgrade. A nicer car, a bigger apartment, more expensive restaurants, more vacations, maybe a few luxury purchases. None of these decisions are automatically bad. That's important. Money is supposed to improve your life. The problem is what happens when every increase in wealth immediately creates a permanent increase in spending. Jordan does something different. Jordan also enjoys some of the money, but instead of turning every temporary financial win into a permanent expense, Jordan keeps a large portion of the capital working. One person increases consumption, the other increases productive assets. 10. Years later, they may have completely different financial lives. And the crazy part? They could have earned roughly the same amount of money. The difference wasn't income. It was what happened to the money after it arrived. This is why hitting $100,000 can be dangerous, not because $100,000 is too much money, because it creates the illusion that you finally have enough money to stop being careful. And human psychology loves this illusion. Behavioral economists call one part of this lifestyle inflation. When your income rises, your definition of normal often rises with it. A $2,000 monthly lifestyle becomes $2,500, then $3,000, then $4,000. And eventually, the things that once felt luxurious start feeling ordinary. That's the trap. Your brain adapts. You don't feel richer anymore. You simply become more expensive to maintain. And this creates a strange financial treadmill. You earn more. You spend more. You need to earn even more. Then you get another raise, and your lifestyle expands again. On paper, you're moving forward, but financially, you're running in place. Now here's where things become interesting. The danger isn't always buying something expensive. Sometimes the bigger mistake is changing your entire financial strategy because you've reached a psychological milestone. Before $100,000, you may have been disciplined. You bought diversified investments. You kept costs low. You avoided chasing every exciting opportunity. Then you hit six figures. Suddenly, you start thinking, I can take more risk. I understand investing now. I can beat the market. I should put some money into the next big thing. And this is where overconfidence enters the picture. A portfolio can make you feel smarter than you actually are, especially when markets have been rising. Imagine buying an investment and watching it climb 30%. Your brain doesn't say, I benefited from favorable market conditions. It says, I'm good at this. Then you take a bigger bet. Maybe another one. Then another. Until your portfolio looks less like a financial plan and more like a collection of predictions. And predictions are dangerous because the market doesn't care how confident you feel. One of the most important investing lessons is that getting rich and staying rich are different problems. When you're building your first $100,000, you need growth. But once you have meaningful capital, you also need protection. Not protection from every loss. That's impossible. Protection from catastrophic mistakes. Because losing 50% of a portfolio doesn't require another 50% gain to recover. It requires a 100% gain. That's why risk changes as your capital grows. The goal isn't to eliminate risk. The goal is to make sure one bad decision cannot destroy years of good decisions. And this brings us to another mistake people make after $100,000. They become obsessed with finding the next big investment. But sometimes the smartest financial move isn't finding a spectacular investment. It's avoiding spectacularly bad ones. Consider what happens when someone has $100,000 invested and starts chasing a stock because it has doubled. They hear about cryptocurrency. A friend has a business idea. Someone promises unusually high returns. A social media personality says a certain asset is the opportunity of the decade. Suddenly, patience feels boring, and boring feels unacceptable because now you have money. But boring is often exactly what created the money in the first place. Diversification, low costs, consistent contributions, long-time horizons. These strategies don't produce exciting stories at dinner, but they can produce something much more valuable. A higher probability of staying in the game. And staying in the game matters because compounding doesn't reward the person who makes one incredible decision. It rewards the person who avoids getting knocked out. Think about a snowball rolling down a hill. The first few minutes are unimpressive. Then it gets larger, then larger again. But imagine stopping the snowball every time it becomes valuable. You would never see the giant snowball. Compounding works the same way. You interrupt it with withdrawals, unnecessary taxes, excessive fees, bad debt, speculation, and lifestyle inflation. The damage isn't always obvious today. That's what makes it dangerous. You don't see the money that could have existed 10 or 20 years from now. You only see the purchase you made today. That's why one of the most powerful questions you can ask after reaching $100,000 is, what is this dollar supposed to do? Not every dollar needs to be invested. Some dollars should pay for housing. Some should create experiences. Some should provide security. Some should simply make your life easier. But every dollar should have a job. Otherwise, money tends to disappear into the cracks. And this is where a second psychological shift becomes important. Before $100,000, you might measure progress by how much you save. After $100,000, you should start measuring progress by how much productive capital you control. That doesn't mean you stop saving. It means you understand the difference between income and assets. Your salary pays you because you work. An asset can potentially pay you because you own it. A stock represents ownership in businesses. A bond represents lending money. Real estate can produce rental income. A business can produce profits. These are different machines for turning capital into future cash flows. And once you understand that, your financial goal starts changing. Instead of asking, "How much can I afford?" you start asking, "How much productive capital can I build?" That question is much more powerful, because a person earning $100,000 with no assets can still be financially fragile, while someone earning less, but steadily building productive assets may be moving toward genuine independence. Income gives you fuel. Assets give you engines. You want both. Now let's talk about the most uncomfortable mistake after $100,000, confusing a higher net worth with financial freedom. Your net worth is simply what you own minus what you owe. It can go up because your investments rise. It can go up because you paid down debt. It can go up because your home appreciated. But net worth doesn't automatically mean liquidity. You can be worth $100,000 and still struggle to pay an unexpected $5,000 bill. You can be worth $500,000 and still depend heavily on your paycheck. So don't just chase the number. Build financial flexibility. That means having enough accessible cash for emergencies, keeping high-interest debt under control, maintaining appropriate insurance, investing for the long term, and making sure your lifestyle doesn't require every dollar you earn. Because freedom isn't simply having a large account balance. Freedom is having options. The ability to leave a bad job. The ability to survive a difficult year. The ability to take a calculated opportunity. The ability to say no. Money becomes powerful when it gives you choices, and $100,000 can be the beginning of that power. But only if you protect the foundation. So, what should you actually do after hitting $100,000? First, don't celebrate by permanently increasing your monthly expenses. Give yourself permission to enjoy the milestone, but distinguish between a one-time reward and a permanent lifestyle upgrade. A weekend trip is one decision. A luxury car with a 5-year payment is a financial commitment. Those are not the same thing. Second, review your portfolio. Ask what you actually own, not what you think you own. How diversified is it? How much risk are you taking? What are the fees? How much of your future depends on one company, one industry, one property, or one investment idea? If you can't explain why you own something in 1 or 2 sentences, that's worth investigating. Third, look at your savings rate. You don't need an extreme number, but you should know where your next dollar is going. If your income increases, consider automatically directing part of the increase toward investments before your lifestyle has a chance to absorb it. This is one of the easiest ways to prevent lifestyle inflation. Your income rises, your investment contribution rises, your lifestyle improves too, but it doesn't consume the entire raise. Fourth, protect against the mistakes that could wipe out years of progress. High-interest debt, excessive leverage, speculative bets you can't afford to lose, inadequate emergency savings, and financial decisions made because you don't want to feel left behind. Because here's the paradox. The closer you get to financial independence, the less you should need to prove anything. You don't need the most expensive car. You don't need the hottest investment. You don't need to tell everyone you're winning. You need a system that keeps working when nobody is watching. And history gives us a powerful reason to think this way. The greatest advantage a long-term investor has isn't predicting the future. It's having enough time for small advantages to compound. That's why consistency can beat intensity. A person who invests aggressively for 1 year and then panics may accomplish less than someone who steadily invests for 20 years. The market will have crashes. Businesses will fail. Economies will slow down. Headlines will scream. New technologies will appear. Old industries will disappear. You won't control any of that, but you can control your savings rate, your costs, your diversification, your debt, your time horizon, and your behavior. Those boring variables can become incredibly powerful over decades. So if you've just crossed $100,000, don't ask, "What's the fastest way to turn this into $1 million?" Ask a better question. How do I make sure I don't destroy what I've already built? Because the first $100,000 proves something important. It proves you can build capital. The next stage is proving that you can manage it, and those are two different skills. Building wealth requires discipline. Keeping wealth requires judgment. Growing wealth requires patience. And eventually, using wealth requires purpose. That's why $100,000 isn't the point where you stop caring about money. It's the point where you should start understanding money differently. Your first $100,000 may have been built mostly by your effort. Your next $100,000 can be built by a combination of your effort and your capital. And eventually, if you keep making sensible decisions, your capital can become a meaningful contributor to your financial life. That's the moment when the game changes. Not because you suddenly became rich, but because your money finally became large enough to start working alongside you. So go back to that number, $100,000. It isn't permission to spend recklessly. It isn't proof that you've mastered investing, and it definitely isn't the finish line. It's a checkpoint, a signal that your financial engine is finally getting powerful enough to matter. The biggest mistake you can make now is treating that checkpoint like the destination, because wealth isn't built by reaching one impressive number. It's built by repeatedly making decisions that allow your money to survive, grow, and compound. Your first $100,000 teaches you how to sacrifice. Your next stage teaches you how to allocate. And eventually, the real goal isn't having a bigger number on a screen. It's reaching the point where money gives you something far more valuable. Options. If you found this useful, subscribe for more practical finance and investing breakdowns, and keep watching the next video, because the decisions you make with your first 6 figures can have a much bigger impact than most people realize.